Okay, and tonight's game plan is to obviously wrap up chapter 6. We still had the last module to go on deferred taxes, and then accounting for income taxes. Deferred taxes is the primary discussion there. And then we're going to jump into chapter 7. My hope is that we will finish chapter 7 tonight. If we can do that, I think that will pretty much get us on track. At that point, I guess I'll go ahead and load the syllabus from e-learning. But I think, if I'm not mistaken, that'll finally get us back on track. And I'm bringing up the syllabus because I just want to make sure that things are going so fast for us here that we are keeping track of that we're coming to a rapid close of things here. So I'm hoping tonight we can wrap up chapter 7, and then we'll be moving along here, finishing class next week, a week from Thursday anyway. Now, I am planning to have a final review session that will be after the official end of the class. I'm thinking that's going to be the weekend of, not that weekend of the 22nd, but the weekend after that. So that will, sorry, I was just going to look at my calendar. That will likely be the weekend of, John, May 1st, May 2nd, that weekend. So I'll be giving you some more information on that, but I will do a final review session. That is optional, probably best for folks that are fine tuning towards their exam in the near future, but that's not required for everyone, but I will do that. And then I leave the class opened. I've been asking them to leave the class open for a few months after the term ends, so that as you're heading closer to your exam, if you want to go back and review something, the recordings and stuff are there for you. Okay, make sure that you are taking a look at the guest speaker thing that I did ask you to do. So that is there. So don't forget that. That's up there too. Expectation that you've worked that. Okay, that you turn that in. Any question on any of that?
I have a quick question, John.
Mm-hmm.
So you know how when you post the lectures, like it's on YouTube?
Yeah.
Do you keep it on YouTube after the class, or do you delete them off?
No, I keep them on YouTube, but good luck figuring out where anything is on my YouTube page, because it's just a jumbled mess, because the organizing portal is through the learning management systems.
Oh.
So if you try to go straight to YouTube, it's a mess. You know, because I don't organize it there. I organize it through the learning management systems. But I'm leaving those, I'm leaving these classes open. I'm asking the university to leave them open like 6 months.
Oh, okay.
And whatnot. So you should still be able to go in and look for it. And then if you find yourself just, you know, oh, I gotta see that lecture again, you know, I can probably figure out on a one-off basis, you know, where a particular one is, and help you that way if you reach out to me. But in terms of being able to systematically go back and find all of them or something like crazy like that, that would be tough from the YouTube.
Right. Okay, cool.
Yeah.
Thank you.
You can probably find classes from your San Jose State class up there.
Yeah, I know.
You know, it's like I said, it's a mess. Someday I should delete some older ones at a minimum to try to clean that up a little bit. I keep waiting for YouTube to tell me you have too many videos loaded up, but apparently they don't stop you. So, okay.
All right, thank you.
Mm-hmm. Okay, good. Let's go ahead. And I tried to stall a little bit because I did see a late arrival of the class, but you know, we carry things out to the end, guys. I'm going to continue to monitor to see that you're here. And if I see people missing class on a regular basis, that is going to affect the grade because this class is all about attendance to a large extent. So, okay. All right, good. Let's go ahead then. And I want to jump us in where we left off on chapter 6 now, talking about deferred taxes. Okay. They call it accounting for income taxes, but it's really a deferred tax discussion more than anything. So let's just first, though, dispense quickly with this idea of intra-period tax allocation. And all they're telling us here is that when we look at our income statement, okay, some things are going to be reported before tax, okay, on our income statement. And we saw that way back in F1. And that's going to be, you know, where we'll show, remember, I told you we have what? Operating, non-operating, and then we had our tax. And remember, the tax was a separate section of those three pieces of the income statement back in chapter 1. When we reported discontinued operations, okay, again on the income statement, that was what? Net of tax, as was the case for our cumulative effective change in accounting principle. That was also reported what? Net of tax, although it was reported as an adjustment to the beginning balance of the retained earnings of the earliest period presented. So that was all back in chapter 1, and I'm not going to get into a repeat of other comprehensive income discussion. That's just, I'm just pointing that out so you know what they're talking about when they call it intra-period. It's within the current period as we're sitting there and showing the different pieces of our income statement. Some things are before tax, some things are net of tax. Okay, now you come over, and where I really want to spend our time now is talking about, and they call it inter-period tax allocation. And they're calling it that because it's basically dealing with tax between two different periods. So what happens? In one period, I report, well, every period, but I report my taxable income to the IRS, and presumably I will have if I had taxable income, I'll have a tax payable there, and I'll send a check to the IRS. But what happens is our FASB GAAP income will be different than the income that we report to the IRS. As a result, that will give rise for temporary differences that'll give rise to either deferred tax liability or a deferred tax asset, okay, depending on which direction my tax income is versus my GAAP income, okay? Now, we will see that these deferred taxes, okay, will either be the current year taxes that we're sending to the IRS is always going to be liability. It's our current taxes payable. That's the amount that we're going to have to send to the IRS. Of course, we'd have to have taxable income for that to be the case. Future years taxes, okay, can give rise to either deferred tax asset or deferred tax liability. It just depends, okay? And these will be driven by these temporary differences. And we're going to talk more about temporary differences here in a couple seconds. But I want to stop here at permanent differences, okay? And the most important thing about permanent differences is they do not affect my deferred tax computation. They do not result in deferred taxes. Write that, flashcard that, okay? Because you're going to have to start getting used to when you look at questions and they start trying to ask you to calculate the deferred tax liability, the deferred tax asset, the current portion of your tax expense, the deferred portion of your tax expense. they're always going to toss a permanent difference in there, and you're going to have to get used to ignoring those permanent differences. And we're going to take a look when you're calculating your deferred tax asset liability, current portion, deferred portion of your tax expense. You will ignore the permanent differences. Okay, now permanent difference is something that enters into pre-tax GAAP income and will never, the word never, okay, and how often do we use the word never in accounting, right? Will never enter into taxable income, okay? So there will never be an effect on our taxable income, okay? Mirror image of that is what? It will enter into taxable income, but will never enter into my GAAP income, okay? So since they never reverse, they never turn around, they do not affect deferred tax, okay? What affects my deferred tax are temporary differences, okay? Temporary differences are things that will enter into pre-tax GAAP income in a period before they enter into taxable income, or the opposite, they enter into pre-tax GAAP financial income in a period after they enter into taxable income. These are called temporary differences. These are the things that affect my deferred tax, and we will need to know how to deal with these. Okay. Now, they tell us that, what I just said, that the temporary differences affect the deferred tax computation, and temporary differences will either result in a liability for future taxable amounts, we call that a deferred tax liability, or a deferred tax asset for future deductible amounts. So think about this for a minute. You have an amount that you've declared on your GAAP, that you've reported on your GAAP financial statements, and what happens? You haven't reported it yet for tax purposes. Well, eventually, for these temporary differences, you're going to have to report them for tax purposes. That will result in a future tax liability that you will have to pay in a future period. Future sacrifice of an asset, definite, meets the definition of a liability, we'll report that liability. A deferred tax asset says, hey, you haven't taken a deduction yet for tax purposes, and you will be able to take that in the future. Well, now you've got what? You've got a tax benefit coming. That meets the definition of an asset. We'll call that a deferred tax asset. We'll be taking a look at these here as we go through some of the examples, etc. Okay. Now, you come over and they call that interperiod tax allocation. Okay. And for the interperiod tax allocation, our income tax expense will be the sum of the current year tax expense, that is what? The current tax expense or benefit, and the deferred tax expense or benefit. Okay. Now, our current income tax expense, the current income tax expense, because we have to break them out to current and deferred, is always the amount that is going to be payable, and they're talking about the form 1120, guys. I am going to ask you to flashcard a few things about tax law here. You don't have to go back and redo your whole review of the regulation course to be able to handle these things. They're pretty straightforward things that they tend to focus on for deferred tax. And I will ask you to look at some of those things. But the current tax, they say that is on Form 1120, that's a report as your taxable income. You multiply that by the tax rate, the appropriate tax rate. That's the tax payable that you're going to send to the IRS. Okay. Now, if you have a deferred tax expense is equal to the change in the deferred tax liability on the balance sheet, or the change in the deferred tax asset. Okay, so come over and let's just take a look at this. And this is probably the most important thing for you to flashcard here. Okay, this is going to be helpful for you to get into your mind's eye. And I'm going to mark this thing up for you a little bit. Okay, but let's just take a look at the pieces here. First, we have what you report on the tax return. You multiply that by the current tax rate. That's your current liability. that's the check that you're going to send to the IRS. Now, where we want to end up, okay, home for us over here, I'm going to just put a little house here, is what? Is the tax expense. Well, how will we figure out the tax expense? Okay. And so we're going to take that current liability, and they kind of mess this up a little bit that they say plus or minus the deferred liability, deferred asset, and they put the plus by the liability and the minus by the asset. And that's a little misleading. Okay. So what I want you to write in here, okay, and I'm going to write it in and say it. So stay listening and write in with me. Okay. You take the current tax liability, that's the amount that you're going to send to the IRS. That's based on what you report on your tax return, your taxable income. Let's write that up there. Your taxable income times the current tax rate, that's your current tax liability. And then up where they say plus deferred liability, right? Well, it's actually plus the increase. So I'm putting this with the plus sign here, guys. Let me do it like this, okay? It's plus the increase in deferred tax, and now I got that stupid house in the way. Deferred tax liability, or it's plus the decrease in deferred tax asset. Okay, I'm going to read that back to you, and I'm just showing you for the plus part here. Okay, this relates to the plus part, so it's not specific to the deferred tax liability. If I was redoing this, telling Becker how to make this look better, you take the current tax liability. Current tax liability is your taxable income times the current tax rate. That's your current tax liability. And then to get to your tax expense, you're going to add either the increase in the deferred tax liability or the decrease in the deferred tax asset. Okay, with me so far? Okay, now let's just do this green for the deferred tax, for the minus. It's for the minus, not so much for the thing that's written there, deferred tax asset, but let's just do green down here. The minus, okay, the current liability, you would subtract the decrease in deferred tax liability, or the increase in deferred tax asset. Okay, so again, don't trip so much on how I know that the asset and the liability are highlighted there along with it, but the real focus is on the plus and the minus side. Okay, so what happens? Current liability, we take what? We take the taxable income times the current tax rate. Okay, and then we look and we see, well, what are we supposed to do to figure out the tax expense for the period? You take the increase in the deferred tax liability times and it's important that we know that you're supposed to use the enacted rate at that point. We'll practice more with that. The enacted rate, and if it's an increase in deferred tax liability, you'll add it. If it's a decrease in the deferred tax asset, you'll add it. If it is what? A decrease in the deferred tax liability, a decrease in the deferred tax liability, you will subtract it. If it's an increase in the deferred tax asset, you will subtract it. Okay, any question on that? flashcard this. I think you're going to see that as you go through the problems, if you follow this mantra here, and it takes a little bit of a while to sort of get used to how it works, you're going to be in good shape to answer all the questions that you have to go through here. Okay? Okay, good. Let's come over them and let's just take a look at permanent differences. Okay, and as we've said, permanent differences, I've already had your flashcard, do not reverse themselves, and therefore they do not result in any deferred taxes. Okay, now examples of permanent differences, and again, I don't want to turn this into making you have to go back and restudy regulation, or you haven't gotten to regulation yet and you're like, huh, what is all this stuff? Okay, so go ahead and flashcard all of these differences. Okay, but let's just talk about one just so we kind of get a visual in our mind as to what permanent differences are all about. So the Constitution says that the federal government will pass no law that interferes with the revenue generating activity of state or local governments. I think it says state, I don't think it mentions local. But for that reason, the federal government cannot tax the interest on state and local bonds. And they will never be able to tax the interest on state and local bonds. Sometimes I hear politicians and stuff say, well, one way to raise revenue would be to tax the interest on the municipal bonds. And I think some state would challenge that as being unconstitutional and likely win. And the only way you can amend the Constitution is if a significant number of the states agree. And why would the states agree to do something that's going to interfere with their revenue generating activity? They're not. And so that's one of those things that will probably never change because it's instituted in the Constitution. Anyway, more information that we need here. Since that will never be taxed at the federal level, that's a permanent difference. And what? It does not affect the deferred tax computation at all. Okay. Now they give us this pass key down here, and why don't you go ahead and put that in the pass key as well, okay, and the flashcard as well. The deduction for business interest expense is limited to the sum of business interest income plus 30% of adjustable tax income, okay, and they're putting that as a tax pass key. I'm telling you right now, that was written by a tax person who probably loves tax law and couldn't resist themselves, but put it there anyway, just in case. But again, that to me is getting way too much into minutia of tax that the deferred tax computation typically doesn't get in. Deferred tax discussion on the CPA exam typically doesn't get that granular, okay? They may even, in many cases, just go ahead and label these things as permanent differences, and then you know that you should ignore them for deferred tax computation. Okay. All right. Now, with all that, okay, before you maybe start to feel like, oh my God, what am I doing here? Right. Okay. Let's just look at this and notice that for this one, they call out two permanent differences. Okay. Municipal interest will never be taxed. Life insurance premium proceeds will never be taxed at the federal level. So what happens? There is no deferred tax liability asset. They simply take that taxable income, multiply it times a tax rate, 21%. And, you know, tax is so annoying to me. I'm sorry if you're a tax guy, but, you know, it's like, really? Now it's 21%. It was 40% before, 30%. Now Biden wants to increase it, so it's going to be some other percent. I mean, these things drive me nuts, okay? Typically what the examiners do is they only will test you. They're not going to make you pick out the rate. They're going to just tell you, this is the tax rate, okay? So don't worry. You know, if you're like, oh my God, I got to remember what the current tax rate is. No, they're going to tell you in the problem what the current tax rate, what the enacted rate is. They'll tell you, you just have to know to pick that up, multiply it times the taxable income. And since there is no temporary difference here, there is no deferred tax. That's the takeaway from that example. Okay. Okay, good. Now you come over and let's take a look at temporary differences. And now we're going to see that these temporary differences is where most of our attention is going to be spent. And we're going to be sitting here and seeing how temporary differences, don't worry about that chart. Again, gets too granular for our purposes here. But let's go ahead and flashcard right here, okay? Temporary differences will result in a deferred tax liability or a deferred tax asset. We have a deferred tax liability if future tax accounting income is greater than future financial accounting income. We have a deferred tax asset if our future tax accounting income is less than our future financial accounting income. Okay, so we basically are saying, hey, we got some deductions coming. That's going to be result in deferred tax asset. Hey, you took a deduction, but you're not going to be able to take it in future years. That's a deferred tax liability. Okay. All right, so let's start with the discussion of our liabilities. And let's just go ahead and take a look at this example on the next page. Okay. And you've got this company that is sitting here and they've got what? They've got their tax return and they got taxable income of 200,000. Okay, so we do what? We multiply that by the tax rate, 21%. That's going to give me now the amount that I'm going to send to the IRS. That's always my tax payable. That's going to the IRS. That's my current tax of 42,000. Now, when I read through this problem, they say that they reported financial income of 225,000 versus the taxable of 200,000. Now, let's see what that's all about. They tell Stone Company's year one depreciation, tax depreciation exceeded its book depreciation by 25,000. So what's happened? I've been able to take a deduction for tax purposes, right, that I haven't taken for book purposes yet. Later, what's going to happen? My book depreciation is going to end up being more, but my tax depreciation will be less. When my tax depreciation is less, I'm going to have to pay more tax in the future. Therefore, I have a future sacrifice of an asset that's coming, a liability. So notice, since they started the year at 0, then the change in the temporary difference was 25,000. I multiply that by the only tax rate they give me in this problem, the current rate of 21%. That means that my deferred tax liability went up, right? They're saying they just started operations, so the beginning balance was 0. If I now realize that I have a deferred tax liability of 5,250, it went up. What do? You add the increase in the deferred tax liability per our flashcard. That becomes now your tax expense, right? We said how to calculate the tax expense was sort of home, where I was saying, you had to get to that home and then later I erased the house. Okay, so what happens? Here's the amount that's going to the IRS. Here's the deferred tax liability. Okay, and then for my tax expense, and the reason I'm showing you how to calculate it here because sometimes the question will just ask you, they'll give you this information and they're going to ask you the home, they're going to ask you what's the total expense. But notice I break that into the current portion, which is the amount going to the IRS, and the deferred portion, which increased my tax expense, which was also the increase in the deferred tax liability here of 5,250 in this example. Okay, so even though we're showing you how to calculate the total tax expense, it's almost easier than that, and that you have to break your tax expense, and you'll literally report it on your income statement into the current portion of your tax expense and the deferred portion of your tax expense. Okay, question. All right, good. Now, what happens? Then in year 2, they determine that this is going to turn around in year 2. Depreciation, temporary differences don't typically turn around that quick, but okay. They're telling us that it turned around in year 2. So what happens? Well, now I have what? I have a decrease in my deferred tax liability, and assuming that there was no other tax expense for that period, then I would go ahead and credit my income tax benefit deferred. That $5,250 decreases my tax expense, and I will literally show that as a subtract from my tax expense for the period, so that my net tax expense net of that decrease here in the deferred tax liability. You know, it's not easy to see when they don't give you also taxable amounts for the year. But if this was the only thing that happened and they had no income, then they would actually increase their net income by this decrease in the deferred tax liability. Okay. All right, good. Let's take a look at a couple questions, see how we would work those. And I'll give you a couple more extra minutes with these because I know they get a little bit involved for you. So I'll give you 2.5 minutes on this one. Okay, guys, let's go ahead and wrap up your choice on this one. Okay, and just taking a look, we have decent progress on this one, 69%. We like to get 75, but okay, I think that we're just sort of getting started on how to answer some of these. So let's just go ahead and take a look at this one. And the answer here is B, okay? And the key here was that they asked us what should we report as income tax expense current portion. And remember, the current portion is going to match what? The tax payable, which is what we're going to be sending to the IRS. So if you look at this one, they tell us the taxable income is what? Is 140 here, okay? And so if the taxable income is 140, then I'm going to multiply that times the only rate they gave me in this question, which is 21%, times the 0.21 gives me the correct answer here, 29,400. Okay, so I'm just going to report that as the current income tax expense. The current portion is what I'm going to send to the IRS. Okay, now take a look at this next one, and I'm just going to point out to you that here they're asking for the deferred tax liability, same fact patterns. So let's see how we do with this one. Okay. Okay, guys, you want to go ahead and start to wrap this up? All right, good. Okay, yeah, good. We're up almost around 90% here, and I think you're probably starting to get the hang of this, so that's a good result there. Okay, so let's just take a look at this one. The correct answer is C. And now they're starting to ask us, okay, well, what's happening with the deferred tax liability? Well, first thing we have to remember is what? Permanent difference does not enter into the calculation of deferred tax liability. So this permanent difference, I don't need to consider that at all to answer this question, right? Then they tell me that I have a long-term loss accrual in excess of, oh, let me stop for a second. They didn't call this out as a permanent difference, right? So I need to acknowledge that. because some questions will call it out as a permanent difference, but you see how you did have to kind of have a flashcard that talked about the usual suspects when it comes to permanent differences, okay? But once we saw that, okay, we know we can ignore that. And then they're saying that we have a long-term loss accrual that's in excess of the deductible amount. And then we have depreciation that we're taking on the tax return in excess of the financial statements. So we've got what? We've got a net temporary difference here of 15,000. Some can go against you. Some can go one way, some can go the other way, okay? And so I know that I have that 15,000, and so net, on a net basis, my deferred tax liability, because they tell me this was their first year of operations, my deferred tax liability went from 0 to 15,000. So my deferred tax liability increased, and so I'm going to take that 15,000 times the 0.21, and that becomes my deferred tax liability. Okay. Now you can sort of look at these two questions in concert. Okay. And if they ask the total tax expense, anyone care to volunteer how you would calculate that? What if I needed to get the tax expense?
Would you add the two?
Yeah, thanks, Avi. Yeah, I would add the two. I would take the 29.4 plus the deferred tax liability, the 3,150. Okay, and the reason I'm doing that, because I think a few of you picked, is the sum of that 32,550? I think it is, just eyeballing it. And so I think some of you picked that, but remember, when we report tax expense, we do what? We break it into its deferred and current portions, and that just asks the current portion. The deferred portion of tax expense, if it had asked me that, would match the increase in my deferred tax liability, right? Okay. Okay, good. I just did that up there. That's not the right answer. Okay, that's not how you did it. I just did that there because I think a few of you picked C that first time, and that might have been what was confusing you. All right, good. Let's come down and let's just take a look at the deferred tax asset now. So what happens? Now, let's just look at it. Deferred tax asset arises when the amount of tax paid in the current period exceeds the amount of income tax expense in the current period. So we're going to have what? Future deductible amounts. They are anticipated future benefits derived from situations in which future taxable income will be less than future financial accounting income due to, and again, it's temporary differences. Now, what happens? Let's say I'm sitting here and I'm saying, well, I think I'm going to have these future deductible amounts, but I'm not sure that I'm going to have sufficient income in the future to be able to take full advantage of these deferred tax assets. Well, rule of conservatism says, well, you have to show that net of whatever the likely benefit is. Okay, so we will have to take a valuation allowance that is going to be subtracted off of my deferred tax asset so that I will end up reporting that deferred tax asset net of the valuation allowance. So flashcard that, okay, and then let's just come down and let's just take a look at the deferred tax asset, and then they'll bring in the valuation allowance after that. Okay, but let's start with just the deferred tax asset, ignoring valuation allowance. Okay, I know it's not set up very good because we said valuation allowance, you think I'm going to talk about valuation allowance. Not yet. I'll get to it in a second. Okay, all right, so what happens? Let's just look at this black company here, organized on January 2nd, year one, and had pre-tax accounting income of $500,000, taxable income of 800,000. Okay, so because my taxable income is more, I'm basically saying, hey, I'm sending more money to the IRS now than what my GAAP income says I should have to send them. Now, of course, you got to send it to them because the tax law says so. Okay, so you're going to send that to them. So notice my taxable income times my tax rate, guys. The easiest thing in the world they can ask you is, what is your liability for income tax payable? It's always your taxable income times whatever the tax rate is here, right? Now, they tell me that the difference is basically the enacted tax rate for all years is 21%. The only temporary difference that's driving all this is the difference in accrued product warranty costs, which are expensed and paid as follows. Okay, so what's happening? US GAAP says you have to estimate that, what, Chapter 5? You have to estimate that and you have to take an expense so you match with the time of sale. Tax law says, no, you can't take that as a deduction until you actually pay out the warranty expense. Okay, so that's a $300 timing difference. Year 2, year 3, year 4, those are going to turn around, times the 21% tax rate means I've had what? It's their first year of operation, so I've had an increase in my deferred tax asset. What do we do with an increase in deferred tax asset? We subtract it from our taxable income, and so that our financial statement income tax expense becomes this 105,000. But again, I think it's actually almost easier than this because, you know, the question may not, in the last two we looked at, they never asked me that number. They wanted me to tell them the current and deferred portion, and the current and deferred portion essentially match of your tax expense, essentially match what you said was the current payable to the IRS and what was the, and in this case, since it was an increase in my deferred tax asset, right? That part is called out as a benefit because it literally reduces my overall tax expense for the period. And then of course you report the increase in the asset and you report the current portion, which is what you're going to send to the IRS. Is there a question? Did I hear a question trying to come in? Okay. All right, good. Now you come over and what about this valuation allowance? Okay, so let's make sure we're clear here now that this next part is trying to now explain the valuation allowance because the timing was a little bit funky there and that we talked about valuation allowance and then we ignored it for that first thing. But let's just take a look right here now for the valuation allowance. Okay, so when the company pays the warranty cost of 100,000 in year, that's not valuation allowance yet either. Just a second. We'll get to the valuation allowance, I promise. Okay, but let's just take a look right here. When the company pays the warranty cost of 100,000 in year 2, it will do what? It will take 21,000 tax deduction related to warranty costs that will reverse out the related deferred tax asset. So now you notice that what, and again, they're just showing you the portion related to the change in the deferred tax asset. Deferred tax asset went down because now I've used up that deduction for that first year. So because the deferred tax asset decreased, I obviously credit it. And a decrease in deferred tax asset does what? Increases my income tax expense here, 21,000. Okay, and presumably they would have a current portion here too, you know, but they're not telling you about anything else that happened with that company. They're just isolating on the reversal of the deferred tax asset. Okay. Now we got the valuation allowance. So I guess it's got to go all the way over. I'm sure probably just see the next page. Okay. But it's got to come all the way over here. Okay. And let's just take a look at how we deal with the valuation allowance. So now they say, well, okay, we're not going to have any taxable income after year 2. So now what's going to happen? Well, if that's the case, we have to set up a valuation allowance, and the valuation allowance is going to be for those 2 years now that we think we won't be able to take that benefit. So we've taken the 21,000, and then there's still what? There's still 63,000 left in the deferred tax. A deferred tax asset of 63,000 would be recognized, but we'll put in the valuation allowance 42,000. That's for the 2 years, 100,000 each, 21% each year that we will end up, we think we will probably end up not being able to take advantage of that. So notice you don't credit the asset, you credit the valuation allowance, so that net now that's showing as a 0 net deferred tax asset. And you do it that way because I guess there's a chance that maybe they will have income, and FASB has told us this is how we have to report this. Okay, notice we debit the deferred tax asset for the full 63. We have the current portion, which is still based on our taxable income. So all we did here was set up the valuation allowance for the portion that before was going to the deferred tax benefit. Okay. Okay, good. Come over and let's take a look at, I'm not going to go through that problem because it's just more of the same, combining now permanent differences, and there you can look at that sort of on your own. I want to take us over to part 2. Okay. And in part 2 now we start dealing with, okay, we're doing good on time. We start dealing with uncertain tax positions starting in part 2. And guys, there's nothing significant about now. This is part 2. They just wanted to break it into another module. Okay. So what happens? I'm taking a tax position and I'm being a little aggressive in how I'm looking at the tax law and seeing if essentially I'm going to get away with it, if the IRS is going to come back on me and say, no, we don't think so, buddy. They're going to require that I look at the probability that this uncertain tax position is going to hold with the IRS. Okay. And so what I do is US GAAP requires more likely than not level of confidence before reflecting a tax benefit on an entity's financial statements. So how do you come up with the more likely than not amount? Okay, and they go on and on about more likely than not, guys, but I just want you to take a look right here. Okay, and we recognize the largest amount of tax benefit that has a greater than 50% likelihood of being realized upon ultimate settlement with the taxing authority. So let's just go ahead and flashcard that. So you remember that 50%, the greater tax benefit that has a greater than 50% likelihood of being realized. And so we start to come over and we look at this and they say, okay, the chance that you're going to get a 0 savings is 10%. Okay. Actually start at the top here. Okay. The chance that you're going to get a 420 saving is 26%. The chance that you're getting a $300 savings is 25%. So if you took the 26 plus the 25, we have exceeded that 51% likelihood. So we at that point pick up that 300 because that's the one that has the 51% possible savings. Okay. All right, so that's all you have to do there is just look at the more likely than not that is ending up with the more likely than not is 51%, right? So record the largest amount that has a greater than 50% likelihood of being realized. That's the 300. Okay, all right, good. Come over. And we saw this mentioned in a couple of the things, and I sort of, ignored it a little bit because I knew this was coming. So what happens? you're sitting there and they give you these temporary differences that are going to turn around in a future year. And you're sitting there and they're saying, okay, in those problems we looked at, it was expected that the tax rate would be the same in the current year and in future years. But as I've mentioned, you know, different administration, different Congress, different ideas, viruses, no viruses. So they change the tax law around, right? So what if there's a future rate that's mentioned in the question? Well, if that's the case, then if that deferred tax asset liability, that temporary difference is going to turn around in a future period, and that future rate has the key word enacted. That future enacted rate, it's got to be enacted rate, is different from the current rate, then you have to use that future enacted rate. Okay, so you take a look here, and in this example, they tell me that the current rate is 30%, but that's the phrase, guys, enacted rate is 21%. Now you say, what's enacted? It means they passed the law. They've passed the law, and the law does that sometimes. It says, well, the rate is this in 2021, but it'll be this in 2022, and that law is passed. That rate is enacted, okay? Now you come over, and that's exactly what they do here. Take a look, okay? They use the what? Current rate, again, probably the easiest part of these questions is getting the income tax payable, getting the current portion of the income tax expense, because that's basically based on the current rate and whatever your tax return taxable income is, right? Then they had a temporary difference here. Well, this was the problem we saw earlier, in which their tax depreciation exceeded their book. I think we saw this, but the tax depreciation exceeded the book depreciation by 25,000. The key here is what? You got to use that enacted rate that'll be in effect later on when that difference turns around. And so that generated a deferred tax liability, credit the deferred tax liability, and that becomes the deferred portion of my tax expense. Okay. They give me the pass key down here. You know, make sure you use enacted rates. They use some other words, but the key phrase, the one you need to focus on, if you need to flashcard that, go ahead, is enacted. Okay. Okay, good. So in many of these questions, you've seen that they've been talking about these you know, first year of operation type things, okay? But CPA exam might ask you first year of operation thing, but typically what we're going to see in these questions, and we're going to practice with a couple of them in a minute, they're going to come out and they're going to tell you, well, look, there was a beginning balance in the deferred liability account. There was a beginning balance in the deferred tax asset account, okay? So now you're going to have to be calculating the change in that account to figure out what your deferred tax benefit is, your deferred tax, your deferred tax expense is going to be based on that change in the temporary difference. Okay, so that's why I gave you that first flashcard that I said is sort of the whole chapter is really about that flashcard. If it's an increase in deferred tax liability, we add that to what we send to the IRS to get our tax expense, right? If it is a decrease in the deferred tax liability, we're going to subtract it. Asset works the other way. Asset increases, subtract it. Asset decreases, we're going to add it. Okay, so let's just take a look here. And they tell me, let's just read the whole question. Julie had previously recorded temporary differences of 10,000. The enacted tax rate in the year the temporary difference originated was 20%. The deferred tax liability had a beginning balance of what? Of 2,000, okay? For the current year, taxable income is 100,000 and financial income is 120. the $20,000 difference. The $20,000 difference is a temporary difference caused by depreciation. The newly enacted rate in the future periods will be what? Will be the newly enacted rate for the current and future periods is 21%. So it was 20%. Now it's 21%. So first off, taxable income, 21,000. Okay, we know that because that's what they said the 100,000 was the taxable income, and they told us that the current year's rate was 21%. So we can always get that number to sort of help us to start to figure out what's going on. But now we sit there and we say, well, look, the beginning balance was what? Was 10. We have this 20,000 difference. So what happens? So we have a $30,000 difference, and the rate when this difference turns around is 21%. So we need 6,300 in the deferred tax liability account, but we already had 2,000 in there. And again, guys, the problem might tell you that it was a $10,000 difference and the rate was 20%. And then they won't tell you the beginning balance the way the example here did here to help you. So you'd have to figure out then, well, if I take the 10,000 times a 20% rate that was affected at that time, the beginning balance was 2. I need what? 43,000 more in the deferred tax liability account. It's gone up. That's added to my taxable income. And so my income tax expense is 25.3. And again, if they, it's even easier when you look here and that you break it into its deferred and current portion. The deferred portion is the increase in the deferred tax liability. Okay, so I think this is more consistent with what you see on the questions that you'll see in your homework and stuff, where they're going to generally say, if it's, you know, first year of operations, that's even easier, right? But they may ask you, you know, hey, they had a beginning balance in there. What is the increase or decrease in the deferred tax liability? What's the increase or decrease in the deferred tax asset? And then that first flashcard that I was showing you will tell you how that's going to affect your tax expense. Okay. Okay, good. Balance sheet presentation, pretty straightforward here, guys. It's going to be recorded as a non-current item. Okay, it's non-current item. They used to have all kinds of rules associated with what type of asset it was related to and whatnot. And FASB significantly simplified that, okay, by saying it's non-current and all deferred tax liabilities and assets must be offsetted and presented as one amount. Okay, include that on the flashcard. Okay, so and then they say you can put that there. It's a little annoying, but okay, go ahead. Let's use all 3 colors here. You know, unless it's different taxing authorities. So I guess a stupid question could say, well, they have a deferred tax asset from IRS, but they have a deferred tax liability from state taxing authorities, then those would be left, you don't net them out. But if it's from the same taxing authority, net out all your assets and liabilities, and then report that as one amount and non-current. Now, it gets a little bit confusing sometimes because when we look at these different transactions, you see them booking a liability, then you see them booking an asset. And you're like, I thought we were supposed to net these out. Well, you got to keep track of them separately at the sort of, you know, subsidiary level. But when you get to reporting them at the financial reporting level and the financial statements, even though you'd keep track of them separately in asset and liability accounts because they all have different timings as to when they're going to turn around and whatnot. So from an accounting standpoint, you'd want to keep your records at that level. But when you finally get to the point where we're reporting on the actual financial statement, you net assets and liabilities, report them as one amount and non-current. Okay. All right, good. Let's come over and let's take a look at how to handle operating losses. And this is one of those areas where I just always struggle with tax law to keep up with these maniacs. Okay. So I thought until I looked at this here that they had gotten rid of net operating losses because they had. But then I guess because of COVID, and they were worried that a lot of companies like airlines and cruise ships and hotels and, important parts of the economy were going to start to suffer losses. They turned around because of the virus. They turned around and said, okay, you know what? We're going to resurrect the net operating loss. Okay. And so you can kind of see that COVID tone in here, that COVID type language starting to hit in here for net operating losses. Okay. So net operating losses arising in 2018, 2019, and 2020 tax years can be carried back 5 years to the oldest year first. So they're anticipating as companies recover from the virus and whatnot, from the economic impact of the virus, they're going to have losses and they're going to let them carry that back against previous year's income to get a tax benefit out of that, right? They can be carried forward indefinitely to offset income in other years, right? So going towards 2021 instead. Net operating loss is utilized in the 5-year carryback period in 2018, 2019, 2020 are not subject to any limitation. Net operating losses carried forward to tax years beginning 2021 or later are limited to 80% of taxable income before the NOL deduction. Okay. Taxpayers can elect not to carry back and carry forward net operating losses arising in 2021 and beyond cannot be carried back, but we can carried forward indefinitely. And that's it. Okay. Flashcard, all that. I don't know what to tell you about tax law, guys. Okay. I can't point to a conceptual framework here. I can point to what their, intent is. I think it's to kind of take away some of the sting, if you will, economic sting anyway, of COVID. But by the same token, it's sort of convoluted in what the rules are, and that's tax law for you. Okay. Now, what happens when we have these loss carrybacks? Okay. If an operating loss is carried back to a year before 2018, the federal tax rate was 35%, then we should use the rate applicable to that carryback period. Okay. Now, what happens? If you are taking a loss and carrying it back against income in a previous period, right? And you're saying, well, now my income wasn't that higher amount, it was a lower amount. Well, you're basically saying, hey, you're going to have to give me a refund because I paid tax on too much income because I was able to carry a loss that happened later back to those earlier years. So a claim for a refund of the past is shown on the balance sheet as a separate item from deferred taxes. It's a refund receivable. So go ahead and flashcard that. That becomes a refund receivable when you carry it back, and you can see the debit to the receivable, and you're going to take a benefit. And again, that's a benefit of the current year, but you use the rate that was in effect at the time that you had that income that you had previously paid tax for, that because of the carryback, you're saying, hey, I want a refund for that money. Okay. Okay, good. Now you come over and let's take a look at what happens with carry forwards. Okay. Now I'm going to take a loss and I'm going to carry it forward to future periods potential income. Okay. So if an operating loss is carried forward, the tax effects are recognized to the extent that the tax benefit is more likely than not to be realized. you have to assume that you're going to have the income in the future to be able to carry that forward too, right? Okay, so tax carried forward should be recognized as a deferred tax asset. Okay, so let's go ahead and flashcard that, they're recognizing the period in which they occur. And so because we felt we had a deferred, a carry forward, that resulted in a deferred tax asset. So we had a net operating loss of 100,000, 21,000 was the tax rate, and we believe that we can carry that forward. And so we'll take a deferred tax asset for that. Now, you may, okay, have to take it as a reduction of you take it as a reduction of your book loss. So the deferred tax asset will reduce taxes payable in the current period, and there'll be a tax benefit, which ultimately, and they're showing you that because the question you may say, well, they had a loss of, 50,000, let's say, but because you have this benefit, the loss now is only going to be, well, let's say it was 51,000. You have this benefit, the loss is only going to be 30,000. Okay. All right, good. They go through a comprehensive example here. I don't think that we're going to go through that. You can take a look at that if you want. Let's take a quick look here, though, at how to handle these situations now where they don't make me pay tax on certain dividends that I get, okay? And I just want you to flashcard how much the exclusion is for these different dividends, and that obviously will result in differences between my tax income and my GAAP income. But I don't want you to get stuck there not being able to remember what the dividend deduction is, because you're sitting here and you're not in the reg class, and that may not necessarily be something that just leaps to mind for you. So I do want you to go ahead and flashcard that. Okay. Okay, good. Come over, and I'm not going to go through the dividends received deduction. Do take a look at the income tax disclosure. Okay, if you need to flashcard that, you can. I do think that the Becker flashcards have those flashcarded for you already, but make sure you do have some flashcards that call out the disclosures for you. Okay. All right, and then they give you this summary, which who's going to look at that? Okay, so let's go ahead and let's take a look at these couple of questions, and then we're going to take a quick break and come back and talk about chapter 7. But let's go ahead and take a look at these. Make sure you know what year they're asking you for, guys. I noticed someone answered the question real fast. Make sure you know the year they're asking you for. Okay, guys, 10 seconds. All right, go ahead and make your selection. And let's take a look at this one. Gonna end the polling. And okay, we got 63% getting this right. Looks like that there's a little bit of interest in choice B here, and I can kind of see why that might be happening, because it is relevant to the answer, but it is not the answer. Okay, so let's just take a look at this one. Okay, and they tell us that they had this income in 2019, bad year, 2020, right? Loss of 700,000. Maybe a lot of companies are going to see that. And then 2021, they get back on track and they have income of 1.2. Okay. Now they say for the year, the Moby company reported the following for its first year of operations. For each year, there were no deferred income taxes, and Moby's effective income rate was 21%. It's the only rate they give me, so I don't have to pick that up. Moby elected to forego the carryback. Okay, so they're not going to carry back to the 300,000. They're only going to carry forward. And in its 21 statement, what amount should we report as total income tax expense? So the reason I was saying, hey, be careful, what year, because you're going to have to keep track of this over a couple of years. So they had 2020, and in 2020, they have this $700,000 loss, and they say, okay, I'm going to carry that back. So what are they going to do? They're going to take the 700,000 times the 0.21, okay, times 0.21. That's going to give them what, 147,000. And just look at it from the standpoint of journal entry. They're going to debit in 2020 now. This is 2020. They're going to do this. They're going to debit deferred tax asset, right? Because that's going to be a benefit in the future when they finally have income of 147,000, and they're going to go ahead and credit income tax benefit. Now, if they asked me, what's the total loss in 2020, I'd take the 700,000 minus the 147. They didn't ask me that though, but if they did, that's how I'd calculate the total loss, because that income tax benefit actually reduces a loss or increases your income if you have it when you recognize the deferred tax asset. But this problem wanted to know what's going to happen in 2021. So in 2021, I'm going to have 1,200,000 of income, but now I get to use up my carry back. So I'm going to sit there, if I'm doing my math right, 1,200,000 minus 700,000, I'm only going to have to pay tax on 500,000 of that, because I'm able to shield some of that against my I'm able to shield some of that with my carry back, my carry forward. Okay, so I take that 500,000 times 0.21. IRS is only going to expect what? 105,000 from me. That's going to be my current. So I'll credit what? I'll credit current tax payable of what? 105,000. I'm going to credit the what? I'm going to credit the deferred tax asset. That's that asset up there for 147,000, because I've used all the benefit associated with that, what, 700,000 carried back. And then I will do what? I will sit here and have to debit my current tax expense for the 105, and my what? And my my deferred tax expense is going to be debited for 147,000. So if you add the 105 and the 147, that's how we come to the correct answer here, the 252, because it asked me what? Total. So finally, you know, there was a question where they asked me the total. Okay. So it kind of got back at the end of the same thing, which is the decrease in the deferred tax asset increased my tax expense over the current amount. So a lot of us picked 105, but we had to realize that we had to kind of track that over 2 years. Okay, good. Let's go ahead and let's look at question 2 then. And then we're going to take the break. Ten seconds, guys. Okay, let's go ahead and wrap this one up. Okay, and okay, 69% of us got it right. The answer is D. Okay, a few of us were interested in C here, so let's just go ahead and let's just take a look, and I'm gonna get that out of the way for us, and let's just take a look at this one. So they say that as a result of differences between depreciation for financial reporting purposes and tax purposes, the financial reporting basis of NOR's sole depreciable asset exceeded its tax basis by 250,000. So it's a different way of telling me that I've done what? I've taken more depreciation for this for tax purposes than I have for book purposes, for my GAAP financial statement purposes. Therefore, I have a what? Temporary difference of 250,000. So they sort of backdoored that on us a little bit by telling us the basis. But remember, depreciation is subtracted off the cost to come up with the basis at any point in time. So once I figured that out, that that's my temporary difference, now I have to figure out the correct rate. And what? It's 21% for future years. Well, if it's 21% for future years, that means what? I need to use that rate because that will be the tax rate when those temporary differences eventually turn around. So that gives me the 52.5. And again, because I've taken more depreciation for tax purposes, it's not an asset, it's a liability. Okay. All right, guys, let's take a quick break. That wraps up chapter 6 for us now. And we're going to come back and I'm going to show you some things for chapter 7 that are already posted in e-learning. And then we're going to start to pick up towards the back end of chapter 7. But I'll show you how that's going to work here in a minute. Let's just take the break right now. And we'll come back at, let's go for, I guess we'll go for 6:40. I'll give you an extra 3 minutes on the break so that we don't have to come back at a weird time. So let's just look for 6:40, okay? Okay, guys, I went ahead and resumed the recording, and looks like I'm going to get the sunshine coming in, so I'm going to close that window that shades because I don't want all that sun right now. Okay, and let's go ahead and let's take a look at chapter 7. Okay, now the first thing I want to show you here is related to chapter 7 is a couple of things that are there for you. Okay, I am going to ask you to look at, I recorded the lecture for pension. I'm going to ask you to look at that on your own. I think it's about, it's probably about 30 minutes of discussion of pension. I'm saving us that time here because I want us to cover things that are going to be more heavily covered on your exam. If you're taking your exam before July 1st, you should watch that because pension is still eligible for testing. If you're taking your exam after July 1st, don't waste any time watching that, okay? Because you're not going to be tested after July 1st on the CPA exam on pensions, okay? But for you folks that are taking it before then, I know there's a few of you, I do have a lecture recorded there and you can watch that. It's going to take you about a half hour to look at that, okay? Stock subscription video, we'll get to that a little bit later, but I'm not going to go through that. It's again, that one's about 10 minutes. Won't take you too long to watch it. I don't want to do it here because this is a light area on the exam, but it takes a while to go through that example, and I'd rather save that time for us to focus on in chapter 7. Okay, and let's just go back to the outline here, and I'm going to just put it in full screen mode. Okay, pensions, had been, about a 5-point area on the exam. There's a potential that they could still ask some questions there if you're taking the exam before July 1st. After July 1st, they are not going to be hitting the exam much with that. Okay. And that's basically the case for this material here about pensions and benefits other than pensions. Where they have long focused, heavier from this chapter is going to be on stockholders' equity. Okay, so we're going to be seeing discussions of how to handle dividends, how to handle treasury stock here. Okay, and they definitely expect you to be able to handle those type of transactions. That's going to be 10 points. And then we'll talk about employee stock options. That has been an area where they have focused, particularly because there's been some controversy in the past about the way those have been handled. So I want to spend the back end of our time here together right here. Okay, as I've said, those other things, although stock subscriptions are part of this 5, 6, 7, but you got a video for that. I want to spend our time on the major chunks here today, and that'll kind of get us caught up so that as we're wrapping the class up here, we're in good shape to get everything done. Okay, so with all that, let's go ahead and let's jump ourselves. Okay, I know there's a way to type in the page here, but I don't feel like figuring it out right now. So let's just do it the old-fashioned way, I guess I'll call it, and just come over and scroll through to page 39. So come over to page 39, and we're going to start to focus on those areas, stockholders' equity. Okay. All right, good. Now, some very, very simple things here up front, guys. Okay, so I'm not trying to insult anyone's intelligence by talking about the sections of stockholders' equity. You've got your common stock, $10 par value. You've got what? You've got your shares that are issued, 30,000. 10 times 30,000 would give us our common stock at par, 300,000. $100 par value preferred stock, 500 shares, 500 shares issued, 500 times the 100 is going to give us the 50,000, right? Then we have additional amount paid in excess of the par, in excess of the stated value. That's my APIC. Then I have what? I have my retained earnings. Retained earnings can be unappropriated, but it could be appropriated for various purposes. And we organize our retained earnings that way so that we don't have the situation where maybe, stockholders think they're about to get a dividend because they see this retained earnings building up. Meanwhile, we're saying, hey, we're setting that money aside for some investment or something, okay? We've talked about what? Accumulated other comprehensive income being, if I'm lining that up right, being part of my stockholders' equity. And then we're going to talk here in a little while about treasury shares. And when you see treasury shares, they are a subtract. Okay, and we'll talk about this more. That's the cost method presentation of my treasury stock. Okay, all right, just a quick visual of what our stockholders' equity section is all about. Okay, so let's just go and turn to the outline now. And we have our par value. Okay, and generally preferred stock is issued with a par value, but common stock may be issued with or without a par value. If you have no par common stock, okay, can either be true no par or no par with a stated value. Sometimes the state will say, hey, you have to have something that's akin to par value, either a par value or a stated value. And so a company will assign a stated value. So just replace the word state par with stated. The stated value becomes the par value, or it could be a true no par stock. Now, any amounts that are paid out in excess of either a par or a stated amount will go to additional paid in capital in excess of par. I know you know all that. I'm probably slipping into my introductory to accounting speech there, because sometimes that's a little hard for students to get down at the beginning of their understanding of accounting. For us, that's all a piece of cake, right? Okay. Now, on the financial statements, we will have to report the shares authorized. Okay, what do I got here? No, that's got my highlighter. Authorized, issued, and outstanding. Okay. Authorized is the number of shares that we are allowed to issue. Now, a company doesn't have to issue all their shares, but let's say they were authorized to issue 100,000 shares. They would literally show that in the stockholders' equity section of the balance sheet, like what we saw in those earlier illustrations we were looking at. Now, let's say the company issued, okay, you don't have to issue all the shares. So let's say they issued 80,000 shares. You don't have to issue all of them. So let's say they issued 80,000, okay? And then let's say they had, and I'm just going to write in treasury stock. And I'm just making this up, guys. Let's say the treasury stock was 10,000. Well, that means now that the shares that would be what? That would be outstanding would be what? 70,000. Okay, so you take off the treasury stock off of your shares that are issued, and that gives you the shares that are outstanding. Okay, now it's important that we remember here that you have to disclose that, similar to what we saw on the previous page. The other thing that we'll talk about more when we talk about treasury stock here in a couple of minutes is when you issue a dividend, you issue it on the shares outstanding, okay? Dividends issued on shares outstanding. Okay, dividends are issued on the shares outstanding. Okay, okay, good. Now we come over common stock is the basic ownership of the company, and common stock is basically bearing the ultimate risk. Okay, so if there's a liquidation of the company, the common stock holders are typically the last in line to get cents on the dollar of what's left if there's some sort of liquidation of the company. Okay. Okay, now again, we see ratio throughout the chapters, okay? And I've told you before that you need to look at every single ratio that we have available, and there's a chapter where they list out all the ratios. Anybody figure out what chapter that is where they list all the ratios as an appendix?
2,
What?
chapter 2.
Is it chapter 2? Okay, good. So I think you probably saw that when you looked at that, they gave you flashcards for all the ratios. Okay, so you probably have a Becker-made flashcard already for this ratio, but do make sure you have it flashcarded, okay? Because I hate the idea of my students missing an easy question because they just couldn't remember some stupid ratio. Okay, so book value per common share is going to be the common shares outstanding, and you're going to divide that into the common shareholders equity. Now, what is the common shareholders equity? Well, you would take the total, and I'm just going to point down just so we see the connection, the total shareholders equity, and then you subtract off any preferred stock outstanding at the greater of its call price or par value. It's usually par value, okay, but the greater of those, okay? And then if there are any cumulative preferred dividends in arrears. In arrears, as you know, are what? Dividends that haven't been paid out yet, but have accumulated, if you have accumulated preferred stock from previous years and haven't been paid out yet. That total then is the common shareholders equity. So obviously to get the first ratio up there, you have to know how to get that second one. And so I want you to go ahead and make sure you got flashcards for both of those. Okay. Okay, good. Now, preferred stock. Preferred stock is an equity security with preferences and features not associated with common stock, you think? I mean, that's why we call it preferred. Preferred stock is generally issued, to your earlier investors before the company really goes public and whatnot. A lot of times, somebody says, well, look, your stupid little idea of your company probably isn't going to succeed. So I want some protection in the event that, you end up going belly up. I want to be, a little higher in line than a common shareholder. Some preferred stock beyond the scope of the exam has such guarantees behind it that you actually list it as a liability versus a stockholder's equity. But we're not going to get into that here for the exam. But you take a look and notice that they say preferred stock may include a preference relating to dividends, which may be cumulative or non-cumulative. It may be participating or non-participating. So you're going to need to read the question carefully in calculating, well, what is the amount of dividend that's accumulating after we have paid any dividends in arrears. If it's cumulative preferred stock, then is that preferred stock participative? If it is participating, whatever word they use, then we're going to have to do what? Then we're going to have to sit there and pay out common shareholders to catch them up. And then we're going to have to go and share up any dividends that are left at that point. Okay, and we're going to look at a nice example of all that in a second. Okay, so cumulative feature provides all or part of the preferred dividend not paid in any years and accumulates and must be paid in future years before we can pay any dividend to common shareholders. Okay, that amount is referred to as dividends in arrears. Okay, now they say if it's not paid, and frankly, if it's not paid or not declared, if it's cumulative preferred, then it's going to accumulate in arrears from period to period, even if it's not declared. Okay, so it says not paid, but it's also not declared. The difference between declaring it or not is that if you have it that it wasn't declared, it does not become a legal liability. If it's declared, then it becomes a liability, and it does go into the calculation of the preferred dividend. Well, it does whether it's declared or not. Okay, but usually the questions will sit there and they'll say to you, they didn't pay the dividend, so that's how you know that it has accumulated for cumulative preferred stock into arrears. Okay, now non-cumulative doesn't. So if there's no dividend paid or declared, frankly, then it does not accumulate. So you would not calculate that as an amount that has to be paid. And the point of the cumulative is it has to be paid to, the dividend has to be paid, the cumulative arrears dividend has to be paid to the preferred shareholders before the common shareholders get anything. Okay, now you come over and participating feature provides that preferred shareholders participate with common shareholders in dividends in excess of a specific amount. So generally, preferred shareholders receive their preferred dividends first, and then additional dividends are shared between common and preferred shareholders. Okay, so I guess you can flashcard these last couple of points, I guess. They seem kind of straightforward for accountants, but go ahead and flashcard those in case you have any problem with those terms, I guess. All right. But if it's non-participating, then, the non-participating, they don't get anything. They don't get any of the share of dividends in excess of whatever their preferred dividend is. Okay. Okay, good. So with that, it's a lot of la. And then you look at this example, and I think you see that it's pretty common sense. And I think you'll look at these kind of questions and you'll get used to them. You'll be real comfortable with these. But let's just take a look. So January 1st, year one, Samuel Company issued 100,000 shares, $5 par common stock, and 25,000 shares of $10 par value, 8% cumulative preferred stock. Okay, so it's participating and it's what? Cumulative, right? No dividends were paid in year one, but they paid a cash dividend of $101,000 and declared and paid in year two. Determine the dividend to be paid to the preferred and the common shareholders. So we've got what? We've got this total 101,000, and we have what? We have the amount that was going to be in arrears from year one because there's no dividend declared or paid. We have what? The dividends for year two. And notice the calculation here, guys. You take the what? You take the par value of the stock times the number of shares times that 8%, right? And that accumulates in year one. It accumulates in year two. We have to pay that out before we can pay anything to the common shareholders. And so we've got 61,000 that's left before we pay anything to the common shareholders. Now, we go ahead and we catch the common shareholders up by using the same sort of formula on par value now of 100,000 times the $5 par for the common stock times and we use the 8% that comes from the cumulative shares, from the preferred shares. And that means we got to pay 40,000 now to the common shareholders. So we've got 21,000 left. And the question is, well, how should we distribute that between my common and preferred shareholders? Well, what you would do is you'd say, well, look, I got 100,000 shares of common, right? $5 par. That extends out to 500,000. And then I've got what? $10, 25,000 shares. For the preferred, right? That extends out to 250. So I've got a total base there of what? $750,000, of which 500,000 belongs to the common shareholders, 250,000 belongs to the preferred shareholders. So when I go and I try to figure out, well, how much should go to each, these are based on the dollar amounts, right? I give 500, 750,000, so the 21,000 to the common shareholders, and the 250,000 of the 750,000 thousands, however you say that weird fraction, goes over to the preferred shareholders, common preferred, right? And so if you say, well, how much went to each, the question could ask you, there's the year 120, the year 220, there's that amount right there, their participating amount, there's the 40,000, there's the 14. Okay. Okay, so not difficult. All right. All right, good. So let's go ahead and let's take a look at the next page now. I'm not going to belabor additional paid-in capital. It's the amount you pay over par, right? Okay. And you can, I guess, look at this, guys. It should not be a problem for you. We looked at this back in F1, net income minus dividends, plus what? Plus or minus whatever the prior period adjustment is that we make to the beginning balance of the retained earnings of the earliest period presented for error correction. And then what we have change in accounting principle is made as an adjustment to the beginning balance of the retained earnings. And that gives us the ending balance of retained earnings. So they call it a formula, but I think you know how these different things affect retained earnings. Net income is a plus, of course. And of course, hey, it might help if they say what? Beginning balance of retained earnings with all of these things being the plus for net income minus for dividends, right? Okay. Now, if you decide you want to appropriate the retained earnings, okay, you debit the unappropriated retained earning, you credit the appropriated retained earning, and you do this so that potentially your stockholders don't see all these dividends building up. All this retained earnings building up, thinking that a nice big dividend's coming, when meanwhile, the company's saying, we're not paying you a dividend because we've got to reinvest this in some sort of research, development, we're getting a new product going, et cetera. Frankly, some investors, and I don't know why I'm pointing to myself, but some investors don't want a dividend. They're going to sit there and say, no. I just gave you my cash. When I bought the stock, I'm holding this stock for the long term. This is a growth stock. I don't want a dividend. Other investors, they're all interested in dividends. And so they may sit there and say, I'm not going to invest in this company because they've got all this retained earnings appropriated because they're a growth stock company. I want my money, I'm old, I'm getting ready to retire. So I want to start to collect some dividends off this stock, whatever. Okay. Okay, good. So with all that, let's go ahead. I'm not going to worry about accumulated other comprehensive income. We talked about that in F1. So let's just go ahead and let's take a look at this question here. Let's do it together, guys, because it's a funky question. So let's just do it together rather than you sit there and struggle and go, okay. Let's just look at it together. On December 31st, year one, Eagle Corp reported $1,750,000 of appropriate return earnings for the construction of a new office building, which was completed in year two at the total cost of 1.5. In year two, Eagle appropriated 1.2 million of retained earnings for the construction of a new plant. Also, 2 million of cash was restricted for the retirement of bond due in year three. And what's annoying about this question is the answer is A, because that's the only amount that they told you would be appropriated for the retained earnings. Now, I look at this question and I'm like, well, I would probably pick D because I feel like this question is trying to tell me that the restricted cash has with it a match of the appropriation of the retained earnings. But I guess because the question didn't call that out as having been appropriated, the answer is 1.2. And I'm like, well, thanks for making the question confusing here. The 1,750,000 is not part of the answer because they finished the office building. So there really wouldn't be any reason to continue to appropriate that amount of cash because that office building is done. So the answer is 1.2 because I guess you're not supposed to assume that this 2 million of cash that they restricted for the retirement of bonds didn't also constitute a restriction of the appropriation of the retained earnings, but it could have. So I think the way they should have properly answered this question was not to have D as a choice. Then I can see I could see this being a fair question. Okay. All right, good. Let's take a look at the treasury stock method. Okay. Now, what happens with the treasury stock? They say is not entitled to vote or receive dividends. Now, you can flashcard that, but of course not. Treasury stock, by definition, is stock that the company has gone out in the open market and reacquired. Okay. Now, you heard about some of this back when Trump was passing the Tax Cut and Jobs Act. I always have trouble remembering what the name of that thing was. The Tax Cut and Jobs Act. They were basically saying that when you cut the corporate tax rate, that companies were going to use that money and they called it stock buybacks. And a lot of companies did. They took the additional cash they got from the tax cut, and instead of using it to increase wages, which did not happen, they took the money and they bought back stock. That's treasury stock. Okay, that's treasury stock. And when we look, companies have basically two methods to account for treasury stock: the cost method and the par value method. Now, what I find annoying is that 95% of the companies use the cost method, yet the CPA exam will still ask about the par value method. So we're going to have to understand both of them. The reason I say that I find that annoying is, the CPA exam sits up there and says, we're going to be changing the exam so we get more current type of things in there. Meanwhile, they sit there and they still test on a method that hardly any companies use anymore. That's the reason, by the way, that pensions, at least they got the point with pensions, is coming off the exam because most companies don't carry defined benefit plans anymore. And so they finally decided, since it's such a rare occurrence that a company carries a defined benefit plan, we're removing that from the exam. Well, I would say that the par value method should go with it, but not yet. It will still be on the exam, even after July 2021. Okay, so let's just take a look though at the cost method first. Okay, and under the cost method, Treasury shares are recorded and carried at their reacquisition cost. Just go ahead and flashcard that. You use the reacquisition cost for that. Flashcard that. Okay, now we will also have an account called additional paid-in capital from Treasury stock, and it is credited and debited for gains and losses when the Treasury stock is reissued that differ from the reacquisition costs. Okay, now they tell us here that these amounts that could be taken as losses may also decrease retained earnings if the additional paid-in capital from Treasury stock does not have a balance large enough to absorb the loss. Okay, now it gets confusing because they're calling it gain and loss. It's not gain and loss on the income statement. Net incomes will never be increased through Treasury stock, so there is no income statement effect. No income statement effect. So even though they're calling it gain and loss, what it's going to do if you reacquire it for, you reacquire it for one price, you reissue it for a higher price, that creates an account called additional paid-in capital Treasury stock. And then as you continue to reissue, you could use that up. But once you use that all up, then any additional amounts go to retained earnings. Okay, so let's take a look here. Flashcard that last. Oh, I told you flashcard that last part. Let's take a look here at this example, and I think you'll see that cost method is pretty straightforward, pretty easy. Okay, so let's just take a look at this, and we've got this company that issues the stock for $15 per share, debit the cash, credit the common stock at par, right? $10 par value. Difference goes to additional paid-in capital. Okay. Now, just to make sure we're sort of tracking how this is going to look on the balance sheet in the stockholders equity section, just flip over quickly to page 48, and you see that subtract of 4,000 for the Treasury stock. So it's like a contra stockholders equity account, that 4,000. Okay. Now that's the cost method. We'll get to the par value method here in a second. Okay. So that's that. Well, it would have been helpful if I would have shown you the Treasury stock. I got so excited to tell you to see page 48 that I jumped the gun a little bit. Okay. So then they buy back the Treasury stock, and they buy back 200 shares at $20, debit Treasury stock. That's that 4,000 subtract, guys. I have no idea why I rushed over there. And then credit the cash because you're buying that back for 4,000. Okay. Now what happens? Now you go ahead and you repurchase 100 shares repurchased for 20 are sold or resold for 22. Okay. So the way I like to do these journal entries, guys, is I like to number them. So one, I go ahead, I debit the cash at the 22 since they resold 100 shares for $22 per share. Then I like to go ahead and I do the Treasury stock, and notice, guys, they take it out of the Treasury stock at that original repurchase price, right? And I need a credit to make this journal entry balance. That credit goes to additional paid-in capital Treasury stock. So if I were to tee that up right now, I've got APIC Treasury stock. What's that? Got 200 in it? Okay. And then a little bit later, they resell the shares that they bought for 20, 100 shares that they bought for 20, and they resell those now at 13. Okay, so what happens? Well, again, I like to do these journal entries in a certain order. First, I bring in the cash, treasury stock, the remaining 100 shares, right? It was 200. There's still 100 remaining. That gets credited out of here at the original reacquisition price. Then I look and I'm like, well, look, I'm going to take the 200 out of APIC treasury stock, but I'm capped at 200 because that's all that was in there. So I need what? This is a true plug, I guess. You sit there and you just debit the retained earnings for the amount left to make that journal entry balance. In effect, you're saying, well, look, if you repurchase shares for 20 and then you resold them and you only got this little bit back, this $13, you in effect have paid out a dividend to your shareholders. Dividends come out of retained earnings. Okay. Question? Okay. That's the cost method. Par value method now that only 5% of the companies use, but the CPA exam insists on still asking us about it, and are recorded by reducing the amounts of par or stated value and additional paid-in capital received at the time of the original sale. Okay, so let's just go over and let's look at the par value method, and it's the same issue that we saw a minute ago when we were looking at the cost method. But now notice what they do. When they reacquire the 200 shares at $20 per share, notice they debit treasury stock for what? At the par. So the treasury stock comes out at par. Then you're going to go ahead, and the way I like to do these journal entries for treasury stock is I go ahead and I credit the cash for the amount of cash they're paying out. And then I sit here and I have to take the additional paid-in capital, because remember, they had originally issued these for what? $15 a share. So $5 additional paid-in capital on the issue times the what? 200 shares that they're reacquiring gives me that 1,000. So that would be the third line of this journal entry. And then I go ahead and I debit the retained earnings, assuming there was no additional paid-in capital in excess of par treasury stock account. That part works just like the cost method. I would go against that account until that's depleted out to zero. And then I would go ahead and make any remaining debit balance to balance that to retained earnings. Okay. Now notice here, I go ahead and I do what? I buy back below the issue price. So the repurchase price. So I repurchase for below issue price, I should say. So repurchase for 12, the issue price was 15, right? So what happens? I still sit here and debit the treasury stock at par. I still sit here and debit the additional paid-in capital for the original. Remember, 15 minus the 10 was where they got the $5 from, okay? But then I go ahead, of course, I have to credit the cash. So I'm going to do this 1. Well, I like to do the cash first. 1, 2, then I get this 3. And since they are repurchasing it for less than the original purchase, now they've created this additional paid-in capital in excess of par. Now, what happens? Notice that how easy it is when they reissue. When they reissue, it's simply what? It's simply as though you had issued that stock for the first time, which is going to be you take in your cash, you credit the treasury stock now, because you're taking that out of treasury stock, and you credit the additional paid-in capital for the difference between the par and the amount that you issued that for. Okay, even if you go ahead and reissue those for an amount that is less than the original reissue price, it's still just as easy. You debit the cash, you credit the treasury stock at par, and you credit additional paid-in capital for the difference. Okay. I don't know. I get some students tell me, I like the par value method better. I get other students say, I dig the cost method. I guess I like the cost method. I like knowing the cost method because what? Because more companies use it. Okay. Now you come over and notice here, guys, that I showed you how we show the treasury stock, and they're the cost method. It's to subtract off the total of the stockholders' equity. Under the par value method, notice that we just subtract the amount of treasury, the amount of stock that we categorize as being held in treasury at par. And so we subtract that from the common stock par value, and then we go from there with our additional paid-in capital, our retained earnings, etc. Okay. Okay. Now, if you retire the shares, okay, all you're going to do is when you retire the shares under the cost method is you're going to go ahead and debit the common stock at par, get rid of any additional paid-in capital associated with that stock, debit the retained earnings for any amounts that are left to balance as you eliminate the treasury stock account. Under the par value method, you're simply going to get rid of the stock out of the common stock account and credit the treasury stock, because you're getting rid of those shares, you're retiring those shares. Okay, good. Let's look at, do we have a question coming? We do not. Well, that's not good. How do I expect you guys to satisfy your multiple choice question answering Jones without giving you a question there? Okay, accounting for stock subscriptions, guys. I've already shown you. There's a quick video there that I put together that talks about that. I think it's better for our purposes if you do that, because this example gets a little involved, and I think it's good that you got a video dedicated to that. You can go back and look at it. Light area on the exam, but this example is kind of hard to follow. And at this time of the evening, I don't want to sit here and make you sit through that. So look at that video that I put together on that on your own. You'll be fine. Okay. Okay, good. Let's take a look at dividends. Okay. Now, you know that you have what? Cash dividend. You know that you debit the dividend. You credit the cash. You know that. Okay. At the end of the year, you close that dividend account, don't you? Dividends, we keep track of them by year. So we would close the dividend just like we close expenses. The only difference between expenses and dividends, though, is that dividends are reported on the statement of stockholders' equity, whereas, reduction retained earnings, whereas, expenses they affect retained earnings too, but they run through the income statement. So we would debit income summary and then close income summary, retained earnings for expenses, right? Now, I do see sometimes on the CPA exam, the reason I'm bringing all this sort of basic stuff up is sometimes the CPA exam thinks about the dividend this way: debit retained earnings, credit cash, and it ends up having the same impact ultimately on the financial statements. But when I see something like that, I make the argument, well, where do you want to report the dividend account? I mean, do you just want to sit there and, call out of the sky what your dividends were? I mean, we have accounts and accounting so we can keep track of things so that we can report them on our financial reports. And if I have my beginning balance of retained earnings minus my dividends, I might want to have an account called dividends that I can keep track of those dividends so I can roll them up and report them on my statement of stockholders' equity or my statement of retained earnings. Okay. Property dividend, okay, instead of debiting, crediting cash, if you were distributing inventory or property, you would credit inventory, you would credit land, whatever it is, okay? Okay, good. So let's just go ahead and take a look at scrip dividend, okay? And a scrip dividend may be used when there is a cash shortage on the date of declaration, retained earning is debited. Instead of on the date of declaration, retained earning is debited instead of crediting dividend payable, they will credit a note payable, and that constitutes a scrip dividend. And then it begs the question, well, why are you paying a dividend if you have a cash shortage? But okay, never mind. I'll let that go. Just know that that's a scrip dividend. Okay. Liquidating dividend, we talked about back in F4. Just remember, if you pay a dividend in excess of the entity's share of the retained earnings, that's called a liquidating dividend, and liquidating dividends will reduce paid in capital. You can flashcard that. We talked about that more back in F4. Okay, all right, so let's deal with what we're trying to get to here, which is this notion of stock dividend. Okay, now stock dividend can be a large stock dividend or a small stock dividend. And the difference is that for a small stock dividend, when we go ahead and record that dividend, we'll record that dividend using the market price of the stock's market price, okay? The fair value of the stock. Now, just let me back up a little bit, slow down a little bit. When we talk about a stock dividend, now the entity is distributing their shares of stock as a dividend as opposed to, say, cash, right? And if it's a small dividend, when we record that dividend at the fair value of the company's stock. If it's a large dividend, then we go ahead and we're going to just use the par value to record that dividend. Now, that stock dividend. Now, they say 20 to 25%, and the question I automatically get is, well, what if it's 22%? That's not what the CPA exam does. They will put you well below the 20%. They'll say it's a 10% dividend or something, or they'll put you well over the 25%. They'll say it's a 30% dividend. They're not going to squeeze you in that middle and expect you to know what to do, okay? So when the dividend is less than 20 to 25%, then the dividend is treated as a small stock dividend. And if we have a small stock dividend, then we're going to sit here and use the fair value of the stock dividend at the date of declaration is transferred from retained earnings to capital stock and additional paid in capital. Okay, so go ahead and flashcard that, and that's like the funkiest way in the world of writing a explanation of something that's very simple, which is we have a small stock dividend here. What is it? 5%. Okay, 5,000 shares out of 100,000. That's a 5% stock dividend. Okay, the fair value of the stock is $15. 5,000 times 15 gives me a debit of 75,000. You're issuing common stock. When you pay stock dividend, you're issuing the stock to your shareholders as a form of a dividend. So what happens? I credit the common stock at par, and I credit the additional paid in capital for the difference between the par and the fair market value. I mean, if I was taking in cash, if I was issuing this stock in exchange for cash, I would debit cash instead of retained earnings, okay? Now, if it's a large stock dividend, okay, and again, you will know that it is a large stock dividend when it does what? Did I say 30%? You know it's small. I'm going too fast, okay? It'll be well less than 19 in order to be small. Did I say it right? It will be well past what? 25 to be treated as a large. Okay, so if you have a 30%, let's say, then you know that that is a large stock dividend. I think I did say it right. And therefore you will use the par value of the stock when you issue that stock dividend. Okay, so you can go ahead and flashcard that. Okay, but let's just go ahead and take a look. And it's a large stock dividend because it's constituting, in this example, 40%. And so what do? They use the par value. The par value of the stock is $10. They're issuing what? 400,000 shares, $10 times 400,000, debit retained earnings at the par, and credit this account common stock distributable. And then, later on, when you go ahead and you actually issue the stock, debit common stock distributable, and credit the common stock account at par. Notice they gave me the market value here. I ignored that for a large stock dividend. Okay. All right. Stock splits, stock dividends not distributed on Treasury stock. Okay, it's always on the number of shares outstanding. Stock splits. Okay, most important thing about not stock splits is no JE. There is no journal entry associated with a stock split. You get a question to ask for the journal entry on stock split. That's one of the few times that the answer will be no journal entry. Okay, what we do is we sit here and we double the number of shares, but we cut the par value in half. So the resulting amount in the common stock account is no difference. And if you don't have a different dollar amount, you don't need a journal entry. Journal entries are used to move dollar amounts around from one account to the other. And if we don't have a dollar amount impact, there's no journal entry. Okay. Okay, good. Let's go ahead and let's take a look at a couple multiple choice questions. Finally. Okay, let's see what we have here for some of these. Okay, guys, let's go ahead and look at this one. And most of us got it right. It's one of those kind of annoying CPA questions that kind of toss information at you and expect you to kind of absorb it all. Okay, so the correct answer is A, but let's just look at it. And they give me what? They give me the beginning balance of retained earnings is what? 420. And I know that I have to subtract the cash dividend. And I know I have to subtract the property dividends, right? Dividends come out of retained earnings, whether it's stock dividend, property dividend, cash dividend, they are paid out of retained earnings. Okay, so that was probably the easy part of this question. But then they wanted me to do something with this excess of proceeds of cost of treasury stock sold accounted for using the cost method. And basically that's saying that I did what? I had acquired some treasury stock and then I sold it for more than I acquired it for. Well, if that's the case, that's going to be what? An increase to my APIC treasury stock. It has no effect on retained earnings. So I guess where you could have got this question right is, remember we had that little part that had you flashcard down there. You can never increase retained earnings by a treasury stock transaction. So there's no way this is added. And I don't think you get to the answer by what? Subtracting it, do you? And so that might have been another way to work this question, but it goes to APIC treasury stock. And when you do the math on this, you get what, 260? Did anybody try to get you can't get the answer by subtracting it, can you? I don't know if there's some weird way of combining the numbers but if you're doing this part, I know you can't get to the right answer by subtracting the 110. You could get there by adding it though. Okay. But you should know you can't increase retained earnings by a treasury stock transaction. Okay. All right, good. Let's go ahead and let's take a look at number 2 here. I'm going to give you a little bit more time with this one. Not that it's terribly difficult question, but you do kind of have to go through the whole set of transactions to figure out what's happening. So I'll give you a little extra time. By that, I mean like 15 more seconds. Okay, guys, go ahead and wrap up. Take your choice here. Take your best choice. And let's look at this one. Okay. And darn, we went down there at the end. We were up around 75%. Then just towards the end, as some answers came in, we did go down a little bit, but we did get most of us with the right answer. The answer is 2000. Okay. Now, when you look at this thing and you kind of read through it, the first time, you would sit there and you would want to see, well, what account are they going to ask me about? And they're asking me about additional paid-in capital related to the Treasury stock. So they're asking me about what? They're asking me about, and I'm just going to tee it up over here, APIC Treasury stock. Okay, I'm going to put that there because I want to see, well, amounts could go in, they could come out. Let's see. Okay, so Porter Company began its business last year and issued 10,000 shares of common stock at $3 per share. They had a par value of $1 per share. Okay, with a question like this, it's best to just go ahead, and that's why I gave you a little bit more time. Just follow the narrative of what's going on. They're not hard journal entries. Take you a couple seconds to slap those out. So we got cash of what? 30,000, the credit to common stock at 10,000, and then we're going to, of course, have regular APIC, not APIC treasury stock, 20,000, right? With me so far? Okay. Now, what happens? Now they go ahead and they buy back, and they buy back what? 500 shares at $6 per share, and they're using the cost method for this. So they take the 500 times the $6. That's what? That's now $3,000, right? Okay. So they debit the treasury stock, 3,000. They credit the cash because they bought those back. Okay, so now they have that in treasury stock. Then what? Then I read a little bit more and they say they reissued the shares later at a $10 per share. Okay, so it's going to be what? It's going to be the 500 shares, and now it's what? It's at $10. So, okay, 500 times $10 that they're reissuing them for. So they're going to get cash of what? 5,000. They're going to do what? They're going to go ahead and take out, I'm pointing to the wrong account here. They're going to take out the treasury stock at the what? At the original reacquisition price. Do I need a debit or a credit to make this journal entry balance? I need a credit, and that credit is what? APIC treasury stock. So I guess I didn't really need a T account because there was only one, that last transaction that hit the APIC treasury stock account. And so that's where the 2000 came from. Okay. But I think for the treasury stock questions, your fast way is the long way. If you sit there, I mean, if you've got this sort of just macro view of what's going on here, you can quickly grind out the numbers here by saying, hey, 10 is what they resold it for, minus 6 is what they had originally reacquired it for. That equals what? $4 times 500. My hat's off to you that your brain is working that fast. I like to do it the slow way because I keep everything in front of me and I know I don't make any misinterpretations of the information. Question? Okay, good. Let's finish up with the stock compensation, and we're mainly going to talk about stock options here. Okay, now stock options is something that you can expect to see on the exam. They're an important part of how companies compensate, attract talent to their companies and whatnot, and it had been the subject of some controversy some years back. So the examiners are going to want you to understand something about stock compensation. Now, I should say stock options. Now you come over and they give us some information about the option price or exercise price. That's the price that they will entitle their employees to buy the stock for. It's generally a favorable price, below market value. Okay, the exercise date is the date that they can exercise that option. Fair value of the option. These days, it's really the Black-Scholes method that is used by most companies. On the CPA exam, they will say they used an appropriate stock option pricing model or method, and they won't say Black-Scholes, but that's the one that everybody uses. Okay, but the exam will give you the value of the option. Okay, the exam will talk to you about the date of grant. The exam will give you the vesting period. Okay, but the other important piece here is they will give you the service period. Okay, so what we're going to see is that we're going to determine that the option will have value. And again, they'll just say an appropriate model, but it's, everyone kind of knows it's the Black-Scholes model, and the exam will give you that. Okay, and then all you're going to need to do is sit there and figure out what the service period is, and you take whatever that value is that the exam gave you, divide it by the service period, and that's going to be the compensation expense from period to period. Okay, so let's just go ahead and let's take a look at this example over here. Okay, and they tell me that on January 1st, ABC company granted stock options exercisable December 31st, year 2, to purchase 10,000 shares of $5 par common stock for $25 per share. I'm reading that fast for a reason, because I don't care. I want to see what is the option, what is the market value of those options. On the grant date, the market price of the stock was $20 per share. Whoop-de-doo. Using an acceptable valuation model, here we go, the options had a total fair value of $50,000. And then they say the options are to serve as compensation for service. There's my service period, 2 years. So it's a piece of cake, guys. You simply do what? You take the 50,000, you divide it by the 2 years. That gives me what? 25,000 compensation expense for year 1, 25,000 compensation expense for year 2. That's the debit. And then the credit is to what? To additional paid in capital stock options. Okay. Now, what'll happen if the employees go ahead and they exercise those options? Notice what we do, and they're assuming they exercised all the options here, and the option price was $25 per share. So the company's employees have to pay that in. They exercised the 10,000 options, so they brought in 250,000 of cash. You issue the common stock at par, 1, 2. Okay, you go ahead and you debit the amounts that you had put into additional paid in capital stock options. That's 3. And then 4, this is a plug. You simply do what? And I'm using the word plug, which I don't like, but that part gets plugged into the additional paid in capital. Now, the other way that you could look at this is to sit here and say, well, look, the stock was essentially issued for $25 per share minus the $5 par value. Okay, that meant that in effect, what? The additional paid in capital was $20 per share times the 10,000 shares. That's 200,000. And then I simply did what? I simply replaced this 50,000 that was in stock options, additional paid in capital stock options, into regular APIC. I mean, you could look at that 250 that way too, or you could just kind of remember the easy parts of that journal entry and then come up with the amount that goes into the APIC. Okay. Now, when the options expire, okay, and you come over and the options expire, and in this example now, they don't exercise all the options. They only exercise half of the options. Okay, so again, 5,000 at $25 a share. There were 10,000. They exercised half of them. Okay, and then you're going to go ahead and issue the stock at par. Take out only half of the amount that went into the additional paid in capital There was a total of 50,000, remember? And then you go ahead and, like I said, you could do that fourth. And then you go ahead and when they expire, you just simply take the final amounts that were left in the additional paid in capital stock options and put that into additional paid in capital expired stock options. Okay, so you got a different APIC account there. You don't put that into regular APIC. Okay. Okay, good. Let's take a quick look at the stock appreciation rights. Okay. And a stock appreciation right entitles an employee, not the employer, the employee to receive the equal of the excess of the market price of the stock at the exercise date over a predetermined amount, usually the market rate. The excess multiplied by the number of rights outstanding is recorded as compensation expense and a liability. Let's go ahead and flashcard that part. Okay, now compensation expense for stock option rights outstanding must be applied annually to account for changes in the market price of the stock. Unlike stock options, stock appreciation rights don't require employees to make a cash payment. Okay, but let's just go ahead and let's look at this example. You see, this is pretty straightforward stuff here. Okay, so we have the different prices of the stock: January 1st, December 31st, year one, and December 31st, year two. Okay, and so we've got this Mort, and Mort exercised all of his stock appreciation rights at January 2nd, year three, when the market value of allowed stock was sitting at $40. Okay, so what should we do at December 31st, year one? What should we do at December 31st, year two? And they also show us what to do when Mort exercises the options. Okay, so you take a look. Market price at the end of year one was 45. Market price at the start of that year when they started this stock appreciation rights plan was 30. So we've got 15, and the number of stock rights outstanding was 10,000. So the total compensation expense was 150. Now, since they tell us the vesting period here is 2 years, the service period, I should say, is 2 years, we take that 150 divided by 2. And so for the first year of the total 150, now we're attributing that to the first year, half of it, 75,000. Now what happens? Now you go, and in year two, the market price has unfortunately dropped. The market price at the beginning was 30. So now we have appreciation of $10, and we multiply that times the 10,000 shares. So the required balance now in the liability is 100,000. Change in accounting estimate, guys. You already have what, 75,000 in there. So you go forward with that new estimate. You simply debit the compensation expense for the difference and credit the liability stock appreciation plan. And then when you finally go ahead, and in this case, you're not giving them stock, you're giving them cash for the increase in the value of the stock, right? Because supposedly they're working hard to increase that value so that when you finally issue them the cash on that, they get more cash out of it. I guess it worked the first year. I don't know about the second year. Okay. All right. Let's look at one more multiple choice question here dealing with stock options, and then we'll go ahead and wrap things up. Okay, 10 seconds, guys. All right, let's take a look at this one. I don't know. I'd like to have a conversation with the examiners about a question like this, but okay. The answer is A. It's their exam. I guess they can be vague if they want to, okay? Most of us got it right, but let's just look at this. And they tell us that on January 2nd, I want to stop sharing the results here. They say that on January 2nd of the current year, Kine Company granted Morgan, its president, compensatory stock options to buy 1,000 shares of Kine's $10 par value common stock. The options call for a price of $20 per share and are exercisable for 3 years. Following the grant date, Morgan exercised the option on December 31st of the current year. The market price of the stock was $45 on January 2nd and $70 on December 31st. Using acceptable option pricing model, Morgan determined, here we go, that the fair value of the option granted was $30,000. By what net amount should the stockholders' equity increase as a result of the exercise of the options, the grant and exercise of the option, grant and exercise of the option, okay? Now, first off, is there anything that's going to happen as a result of the grant of the option? No. The granting of the option does not affect anything, okay? What happens is we sit here and we take what? We take the 30,000, which was the option price using a fair value model, right? And what is the vesting period? What is the service period here?
3 years.
Huh?
3 years.
3 years are exercisable for 3 years, right? Okay. So I take that 3 years, that's 10,000 per year, right? So in this first year, I will debit compensation expense for 10,000 and credit what? APIC stock options. I'm just going to call it APIC. Oh, better spell it out. APIC stock options for 10,000, right? Okay. And then they tell me that the dude exercised the option. So if he went ahead and exercised the option, he's got the right to buy what? 1,000 shares at how much? $20 per share. So 1,000 times $20 per share means that cash is coming in of 20,000, right? Okay. And since he's exercising the options, I'm going to go ahead and credit the common stock now, 1,000 shares times $10 per share. So I got to credit the common stock. What's that? 10,000. Right. Now what? Now I sit there and I say, well, since he's exercising the options, I'm going to debit APIC options for 10,000. That's that amount that I put in there. I'm going to debit APIC options for 10,000. And now I have to go ahead and do what? Credit my APIC. And I credit my APIC for what? 20,000. Okay. Now they say Morgan determined the fair value by what amount of equity would result of since the guy went ahead and exercised the option. What would be the result of him exercising the option? Well, the result of him exercising the option is going to be what? My stockholders' equity is going to come up 30 and down what? Down 10 as a result of that transaction right there. So that's how we get the 20,000 increase in the stockholders equity choice A. Now, the problem that I have with this question is they were cute and that they said as a result of the exercise, which is this part, but I'm looking at it and I'm saying, well, but wait a minute, because the retained earnings would come down by this amount, but they asked this kind of cute question, the exercise of the option. And so that limited me to this transaction down here, rather than considering that there was also a decrease in the amount of the stockholders' equity because of the expense, but I can't get to 10,000 anyway. So I guess I'm stuck with the 20,000. Okay. Question? Okay, guys. Next time we're at kind of like, I guess we're kind of caught up, but I don't want the accounting gods to hear us because we've got some work to do in chapter 8 next time, and I'm hoping to get that done all next time. So I will see you on Thursday. We'll jump straight into chapter 8. If you're taking your exam before July of this year, you want to go back and spend a little time looking at that video for pension, and then spend a little time looking at the video, everybody looking at the video for the stock subscriptions. And hopefully you can get through most of this stuff before we jump into chapter 8 on Thursday. Okay.
Thank you.
Thank you.
Okay, guys. Have a good night.
Thank you.
Thank you.
Bye-bye.
Thank you.